Welcome back to Store University Lesson 2, How to Calculate Returns on Equity and Get Really, Really Rich. I'm Chris Volk, CEO of Store Capital, and in our last lesson we learned that using accounting to compute equity rates of return has clear problems. So if accounting has limitations, how does one estimate the value of a business? Well, business value is driven by equity returns. The higher those returns, the more value you can create. And equity returns are a function of three business fundamentals. And actually, they're a function of three interwoven fundamentals: operating efficiency, asset efficiency, and capital efficiency. Operating efficiency is the ability of the business to achieve profitable sales. You sell more units, raise prices, lower operating costs. Embedded in operating efficiency is something called operating leverage. That is the ability to realize more sales without appreciable increases in operating costs or investments in company assets. Generally speaking, if you take one look at the Forbes 400 list of wealthiest individuals, their wealth was derived from business enterprises that boasted terrific operating efficiency and operating leverage. Asset efficiency is the ability of a company to manage the amount of dollars spent on assets. And assets are very broadly defined. They're not just real estate assets that you need or the equipment you require, but also the amount of cash tied up in other assets, such as accounts receivable, inventory. Assets are hard dollar investments that you have made that have to be funded with borrowings or other forms of other people's money or your own money that has to come from shareholders. And finally, returns on equity are a function of capital efficiency, which was achieved by minimizing the cost of OPM or other people's money. Since other people's money can come with strings attached, returns on equity are also a function of maintaining what I call a breathable capital structure that enables you to seize opportunities and avoid pitfalls. Understanding the three efficiencies that combine to create equity value is our first step to business value understanding. In our next lesson, we'll put these three elements to work to compute equity returns. Until then, I'm Chris Volk, thanking you for joining me on this value creation journey.